Good evening, everyone. I am CA Kirti Singhal, moderator of today's webinar. I believe all of you are in good health and keeping safe. Before starting today's session, I'd like to apprise you about the 21st World Congress of Accountants, which is going to be held for the first time in India from 18th of November to 21st of November 2022. To know more about this, I would like to request our technical team to play a short informational video. Please see this and register yourself for the same.
Geographically, the seventh largest country in the world, one of the oldest civilization, world's sixth largest economy, a global hub for innovation with one of the largest startup ecosystem. India, city of Mumbai on the western coast of Arabian Sea, among the most advanced and modern metropolises in the world, and the financial capital of India, gears up to host the most prestigious accountancy event of the world, 21st World Congress of Accountants from 18th to 21st November 2022, an event held every 4 years. The Olympic of Accountancy Profession. India hosts the event for the first time in 118 years since the WCOA came into being in 1904. Around 10,000 delegates expected to join virtually. More than 6,000 delegates from over 135 countries would congregate to exchange views at the world's most advanced Geo World Convention Center. The theme, Building Trust, Enabling Sustainability, will inspire the future of accountancy profession to create sustainable economies for the future.
The ICAI is honored to be the host for this mega event, which will bring together the world's largest conglomeration of professional accountants, regulators, leaders, and visionaries to advance the cause of the global accountancy profession. Now, with the ease of travel restrictions across the world and the situation returning to normal, we are working towards creating a never before and a unique experience for all our delegates. The year 2022 marks the 75th year of India's independence, and the Government of India is celebrating the year in a big way to showcase the glorious history of India. World Congress of Accountants 2022 would also be celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of the country.
A never before witnessed unique experience of learning future trends, emerging avenues, enhancing skill sets, networking, and to explore the incredible India awaits you.
We at ICAI are pleased to host you here in Mumbai, the financial capital of India, for the 21st World Congress of Accountants with the theme Building Trust, Enabling Sustainability from November 18 to 21, 2022, and give you a professionally enriching and personally rejuvenating experience. We are hopeful that the conference shall be stimulating and productive, and your stay in India will be a memorable experience. Once again, we invite you for this enthralling convergence in India, the land of multicultural, historical, and spiritual inheritance since centuries.
Insights from the stalwarts of the profession, international and national standard setters, regulators, and trendsetters will constitute the panel of speakers at WCOA 2022. Let your dream get bigger. Come, be a part of this mega celebration. For registration and sponsorship opportunities, contact. Organized by Institute of Chartered Accountants of India under the aegis of IFAC.
Hello once again. We are delighted to welcome you all to the webinar organized by the Continuing Professional Education Committee of ICAI. It gives me immense pleasure to be a moderator of this session, which is a webinar on valuation of buyback of shares and accounting standards for non-corporate entities. In a short while, we will start this webinar, but before that, I'd like to apprise you about the CPE Committee. The profession of chartered accountancy has always been recognized for the quality of education, training, and strong grip over technical standards. With globalization and increasing business complexities, it is essential that chartered accountants equip themselves with the changes occurring and stand out the expectations of the society. Our institute is constantly working and contributing to cater the needs and requirements of our members and has taken various initiatives for them from time to time in the direction. With this view, the CPE Committee of ICAI has always been foremost to provide the opportunities to the members and boost their knowledge base. So in this regard, we have two sessions lined up for today, which will be covered by two eminent and talented speakers. The program for this evening are as follows. We have two sessions of 1 hour each, and the topics are first, valuation of buyback of shares, and second, accounting standards for non-corporate entities. However, before these, I'd like to introduce you all to a very dynamic personality, CA Dr. Gopal Krishna Raju sir. He will be covering the topic valuation of buyback of shares. Before I hand over to sir, I'd like to give a brief introduction to you all about him. Someone once rightly said, a dream does not become a reality through a magic. It takes sweat, determination, and hard work. Gopal sir is a perfect example for this. Sir is a practicing chartered accountant, registered insolvency professional, and a registered valuer from Chennai. He qualified valuation examination of Insolvency and Bankruptcy Board and Limited Insolvency Examination and Insolvency Bankruptcy Board of India. Sir is a twin postgraduate diploma holder in operational research and in finance management from Pondicherry University. He has completed MPhil in management from Tamil Nadu Open University. He has, not to end with just this, Sir has authored two books. First, Standard Costing and Variance Analysis, and second, First Lesson in Information Technology. Sir is a seasoned speaker on information technology, finance and taxation, and a visiting faculty for numerous institutions, corporates, and big schools. He is a passionate writer on technology and taxation in journals and newspapers. I invite Gopal sir to impart some of his widespread knowledge. Thank you. Over to you, sir.
Thank you very much, Ms. Kirti Singhal, for the wonderful introduction. And a special thanks to Institute of Chartered Accountants, CPE Committee, and also the Karta behind this particular program, CA Rajkumar Adukia ji. Thank you very much for this opportunity to be part of this program as a presenter on valuation of buyback of shares. Good. Now, before I venture into this topic, I'll give a brief. I'll share the screen. Yeah. Yeah. Valuation for buyback of shares. A very interesting topic per se. Now, before I venture into this topic in detail, I want to give you a background. This is one topic which consists of, if you remove the word valuation, buyback of shares, that it's a big area. Because the relevant prescriptions, the relevant provisions of the Companies Act, especially Section 68, 69, and 70. These are the three sections applicable with respect to buyback. And maybe erstwhile 1956 Companies Act, The equivalent of that will be 77A, 77AA, and 77B. That is the equivalent 1956 provision. Now, I will not dwell into the corporate law or the Companies Act prescription for one reason. It will have the procedures to be followed, the conduct of a general meeting, the offer letter, and all this stuff. We are only going to take only one aspect in that, because the entire buyback of shares, I will take the theme first. Why buyback? And then I'll directly go into the valuation part. When we speak about buyback, it can be for various reasons. It can be for various reasons. Number one, generally, say for example, a 1 rupee share face value or a 10 rupee share face value, which was issued some few years back or 10, 20 years back. Today, it will be worth more. Now, annually, dividends have been distributed to the shareholders. Now, instead of distributing dividend, one way of recognizing my shareholders is to buy the shares, and then you can give a feel to them. Okay, don't worry, your 10 rupees have now become 500. Okay, and you will be surprised. I will be sharing with you some of the annual reports of Sun Pharma, Supreme Petrochemicals, Imami Limited, Dalmia Bharat, Granules India, TCS Limited, Wipro, where especially TCS Limited, you will be surprised. 1 rupee face value bought back at 3,000 rupees. It's very interesting. Okay, so it cannot be imagined. Okay, where is 1 rupee? Where is 3,000? It is 3,000 times it has grown. Now, one way is to give the feel to the shareholders. Yeah, it's such a worthwhile company. Number one. Number two, the base, when you reduce the base, when the spread of the shares, number of shares are more, maybe the volatility, okay, and whether the price will go up, maybe more the demand, okay, if you have to create the demand, price will go up. So one way is the base is actually reduced. So how to reduce? And of course, under the Companies Act, you cannot reduce the base one shot. You can actually do some here and there, some base corrections, and you cannot buy back beyond. Okay. Of course, if it is a listed company, it is 10%. And unlisted, you can go up to 25%. All these are given in the Companies Act. So I will not go into the provisions part of it. Okay, so all of you are aware about it. So anyhow, I will be giving you the relevant provisions also. So that is why I will be sharing with you the Companies Act and the related provisions. If you look at it, the company share capital debenture rules. Respective rule I will be discussing. CB buyback of securities regulation 2018. The previous regulation was 2000, not 2018, it is 1998. This was the older. Okay, so maybe this is the older version. Okay, so this is now that has now become 2018 regulation. So this SEBI buyback of regulation is applicable only for listed companies. So I'll make this clear. This is only applicable for listed. The company share capital and debenture rules 2014. This is applicable only for unlisted as well as private limited companies. Unlisted public limited companies and private limited companies. So for unlisted public limited and private limited companies, buyback prescription are there in company share capital debenture rules 2014. But a general prescription are there in 68, 69 and 70. So what are the procedures you have to follow? So in 68, 69 and 70, they don't distinguish between companies. Okay, it is applicable for all. So the section will read like the power of a company to purchase its own securities. Power. So of company. So they don't distinguish there. Then how do you transfer certain sums to CRR account, that is capital redemption reserve account? So unless and otherwise you have accumulated profits, you cannot do that. So all these are discussed there. So I will not spend time on those prescription with respect to the corporate law, but I will go to the rule part straight away. So point number one, why buyback? That is what we discussed just now. That buyback is done for one reason, or two reasons, or three reasons. One is to consolidate the share and maybe to give a indication to them that share is worth this much. There can be arguments, okay, there can be arguments favoring buyback. No, you should not do buyback. It all depends upon business circumstances. So you cannot give a fair thumb rule. No, companies after 7 years or 10 years, they have to go for a buyback. No. So there is no such rule that you need to go for a buyback. But one thing, once you have bought your own shares, company issues shares, then that will be in equity. And when the shares are bought back, it is called as treasury shares. I repeat, it is called as treasury shares. The terminology is derived from Indian Accounting Standard 32. India is 32, where in financial reporting, you have to net both. So you have the equity 100 shares. If you have bought back 8% of the 100 shares, so 8 shares, you have to show net only. So 100 minus 8, 92 shares only is outstanding at the end of the year. Because at the beginning of the year, your outstanding shares will be 100. At the end of the year, outstanding shares is not 100. It is actually 92. So that's one point I want to mention before I venture into the next point. So why buyback is clear? What is treasury shares is clear. Now, let me take you to the third one. Okay. Now, what are the different models of buyback? It's only two. Is it a listed company or unlisted company? So, if you are a listed company, then the SEBI buyback of securities regulations is applicable. Okay, I was SEBI buyback of securities regulation 2018 applicable for this. Okay, and most important, promoters cannot participate in buyback through stock exchange, but book building it is possible. Okay, so these are all some of the things in regulations. So just to give you a snapshot about all those. But anyhow, our focus will be on valuation front. Okay, and an unlisted company. Okay, that means unlisted public limited company and private limited company. So for that, we will be going to the company's share capital and debenture rules 2014. Good. So that is for so number 3. Let me take you to the SEBI, and number 4 is the unlisted company. Maybe I'll complete the unlisted part first. So first, let me take you to rule number 17. Okay. So this is your, okay, sorry, where am I? This is company share capital and debentures rules 2014. So here, if you look at it, the 3 sections are referred here. 68, okay. So you have class B of subsection 3, sorry, this is 67. Subsection 2 of 68, subsection 6 of 68, subsection 9 of 68, subsection 10 of 68. Okay, and that's all. So these 3, so from the 68, from here to here. Okay, so those are the areas pertaining to buyback. Okay, so let me take you to rule number 17. And especially, I'll take you to, this is where buyback of shares are the securities. So here 17.1 the G. So let us look at 17(1)(g), which says the basis of arriving at the buyback price. So the explanatory statement to be annexed to the notice of the general meeting pursuant to section 102 shall contain the following disclosure. 102 is about the extraordinary general body meeting, and especially what you have to do with respect to the explanatory statement. So the basis of arriving at the buyback price, it shall contain. So if you look at this part, so 17(1)(g) is the basis of arriving at your buyback price. Now, what is your basis? Okay. Now, when you say the basis of arriving at your buyback price, let me take. So they don't mention that you have to do the valuation, you have to do the take valuation report from a valuer. All this is not mentioned. So the basis for arriving at a buyback price, for example, it is a 10 rupee share. It is bought back at 410. So where is 10? Where is 410? Of course, 410 minus 10, 400 rupees is taxable. Okay, in the hands of the shareholder, but which will be subject to, because you don't have that dividend distribution tax now. Okay, but even though dividend distribution tax is not there, okay, you have to pay tax at 25%. That is why I was mentioning here. Please look at this. 115 QA, the tax will be 20% plus surcharge 12% plus cess 4%. So 23.296% tax has to be paid. Okay. Now, this I am giving you some comparison between buyback and dividend, just to give you an idea, which will be more beneficial. Maybe if it is dividend is paid, 100 rupees is dividend is paid, okay, that is a cash available. The tax, well, it will be taxed in the hands of the shareholder because 1034A is not applicable. Okay. 1034A is applicable only for corporate, this buyback. Remember, if dividend is paid, it is taxable in the hands of the shareholder. If it is buyback of shares, the gain will be deducted okay, and under the rate as a corporate distribution tax. Okay, CDT is now applicable only for okay, so buyback of shares, and the rate is 23.30, and that's what I have mentioned. I gave you that point. So 23.296 precisely. Okay, so precisely. So that will be deducted and paid so that it is exempt. So the entire money is exempt. Okay. So 81.1. This is your gain. Okay, what is taxable? Cash available for distribution. Okay. Now, technically, what is taxable to is only the gain. Okay, technically, what is taxable is only the gain. But in a buyback scenario, there is one more rule that is applicable, which is called 40BB. Okay, there is another called 40BB rule. I'll also discuss what is 40BB. That is a cost. Okay. So your consideration minus the cost. So sometimes bonus shares will be there. So what is the cost? Cost is actually zero. So you cannot, that means the entire consideration is taxable. So it's a very interesting point. You need to actually appreciate this because this calculation has to be done by the company. Okay. So now if you look at both this scenario, the net amount, okay. So if it's a dividend scenario, he only receives 64.1. And I'm taking the share in the tax rate as the maximum marginal rate. Maybe if he's in the 30% bracket and plus surcharge plus cess. Okay. Maybe if he's in the 20% bracket, well and good. Okay. Well and good. But if it is a 30% bracket, there is a tax impact is there. Okay. Tax impact is there. So that is what I want to bring to your attention here. So now, what do you mean by the basis of arriving at this price? So 410 will be the purchase price. What is 410? Who will give this? Okay. Now, please look at the basis for arriving at this. Better management engages a professional. Okay. Now, who they can engage? Under the Companies Act, there is IBBA registered valuer. Under Income Tax Act, you have a registered valuer under Section 34 AB of the Wealth Tax Act. Okay. So anyone you can engage. And they don't mention, no, you have to only get it from IBBA registered valuer under Companies Act. No. So there is no such requirement under the law. The law is very clear. They only say basis of arriving at the buyback price. Now, I want to make one observation here. Okay, management doesn't get a valuation report. Now, you have to give an explanation to the shareholder. Please look at this. The explanatory statement shall contain the basis. Now, how do you say that this basis is authentic and there is an independent person who has done this analysis? So therefore, better to give an executive summary of the valuation report to the shareholders. Maybe you have a page or one page. Maybe the valuation report contains 150-page document. You can convert into maybe the executive summary will have a 1.5 page summary that can form part of your basis for arriving at your buyback price. Very important. Okay. So number one. Number two, there is one more aspect in the same rule number 17, which I'm going to take you to N. Okay, in N especially 3. The report addressed to the board of directors by the company's auditor stating. Now, what he has to state? That the audited accounts on the basis of which calculation with reference to buyback is done is not more than 6 months old from the date of the offer document. Now, it gives you an indication that can the statutory auditor do the valuation? Yes, he can do. So, I'll just put that here. So, best practice, who can do? Okay, statutory auditor. Okay, he can also do. Now, please look at this part. That the audited accounts on the basis of which calculation with reference to buyback is done. Okay, is not more than 6 months old. That is a report addressed to the board of directors of the company auditor stating. Now, sometimes what will happen, if you go to rule number 11 UA of the Income Tax Act, there also they mention about audited balance sheet, but you will take the book value of the assets. But if it is land and building, you have to take the stamp duty value. If jewelry is there, you have to take the open market value. Okay, then these are the things you have to take minus the liabilities, you will get the book value. I mean, you will get the fair market value. Fair market value under Income Tax Act is a kichidi. Okay, so it is acceptable. And this is one basis. So I'll just put this point very clear to you. Who can be, okay, as statutory auditor, and that is as per 17(1)(n)(3). Okay, this is as per the rules, the company's rules, especially the company share capital and debentures rules. So as per the company's rules, statutory auditor also can give. Okay, because anyhow statutory auditor is going to give a report, and he can also give the valuation report. There is no restriction for your information. There is no restriction. No, there will be a conflict. Nothing like this. Okay. So that is number one. Another point I want to share with you with respect to private limited companies or with respect to the unlisted public limited companies. Maybe if the management feels, okay, so this is the audited or unaudited. Now, unaudited means, please look at this. This has been recently amended. Okay, recently, last year only it was amended. Okay, look at this. Okay, that where the audited accounts are more than 6 months old. Okay, maybe we are now in 2022. Okay, in the month of July. And you don't have 31st March 2022 audited balance sheet. You only have 31st March 2021. So then the calculation, the reference to buyback shall be on the basis of unaudited accounts of 31/3/2022 because it is less than 6 months. Okay. but which are subject to limited review by the auditors of the company. So limited review done. So limited reviewed unaudited accounts you can take, which is less than 6 months, or take an audited accounts, which is less than 6 months. So both, any one you can take. So that will be, okay. So what you say, what they say is, a report addressed to the board of the company's auditor stating that the audited accounts on the basis of its calculation, the reference to buyback is done. So you have to give that. Now, somebody may say, no, can I do income approach? Okay, can I do income approach? Answer is negative. Because as per this rule, okay. So as per this rule, they are very clear. Okay, they are very clear, and auditor has to say, I don't say that auditor, for example, I'm not a statutory auditor of a company, and you are a statutory auditor, and the company approaches me, sir, kuch valuation report dijiye. So I do an income approach, I do the discounted cash flow method, and I give the report, okay, for your information. And it comes to around 450 rupees. Now, as a statutory auditor, what you have to get, a report should be addressed to the board by the company's auditor stating that the audited accounts on the basis of its calculation, the reference to buyback is done, is not more than 6 months old from the date of the audit. Now, here what do you say? Is that the basis? Is the audited accounts the basis? No, you will say no. The audited accounts was not the basis for arriving at the calculation of the price. The basis of arriving at the buyback. You can say. Now, just because auditor is saying no, the basis is not audited accounts, there is an income approach. It is not wrong. For your information, it is right on you. Income approach is an accepted approach, but that has to be reported by the statutory auditor. So that is where the point, because the future prospects are bright, and I would have come through a path of difficult stages. My company is not my book profits or my book size is not that encouraging. So then my price will not be a very effective price. So I'll go by DCF approach. But here I have to disclose very clearly, no, it is not based on unaudited, not based on audited. So that is a point they have made it very clear. Okay. Now I want to now bring to your kind attention the buyback. Okay. Now if you look at the buyback part, okay. That is SEBI buyback of securities regulations 2018. Okay. I want to bring to your attention. Okay. This is the SEBI buyback of securities regulations 2018. Now here I will bring you to your attention what are the mode a company may buy back. So this is as per 4.4. Okay. So regulation 4.4 gives you the types. Okay. So from the existing shareholders through tender offer, open market through book building or stock exchange. I'll explain what is this. And for odd lot. This is what I have put it here as a table. If you look at this, from the existing shareholders through tender offers. So this is tender offer. An open market operation. So that is where from the open market. So that means you go to the stock market and buy. Now you can go to stock exchange and buy, or book building process also you can do. So that is what is given here. So open market can be either through stock exchange or book building. And you have from odd lot holders. Generally odd lot will be not a round share, okay, fraction shares. Now these fraction shares will not be much. Maybe if there are round shares are there, fraction shares will be very, very less. And it used to be in the past. Now, since after demat also, these fraction shares are there. Now you want to remove those fraction shares because those fraction shares may not be frequently traded. Okay, it may not be frequently traded. I want to bring to your kind attention one more terminology. Okay, that is also called as frequently traded shares. But this concept of frequently traded shares is not in SEBI buyback of shares regulation. It is in SAST regulation. The concept of frequently traded shares. and volume weighted average price. These two are not there in SEBI buyback of shares regulation, SEBI SAST regulation, substantial acquisition of shares and takeover regulation. Now here, I'll bring your kind attention to a term called as frequently traded shares. Okay, so this frequently traded shares is in 21J. Okay, and there is one more term called 21ZC. This is here. That is not ZC, this is ZE. Volume weighted average price, and ZB is volume weighted average market price. This is volume weighted average price. This is volume weighted average market price. So VWAP. This is the product of the number of equity shares bought and price of each share divided by the total number of equity shares bought. So this is volume weighted. So you are not supposed to take the quoted price and then take the simple average. Quoted price multiplied by the share trading that has been done. Okay, so that is volume prop shares bought. Similarly, volume weighted average market price means the product or number of equity shares traded on the stock exchange. Traded. Okay, this is product or number of equity shares bought and price of each such equity shares divided by the total number of equity shares bought. That means this is in stock exchange. VWAP is not through stock exchange. Okay, OTC. So volume weighted average market price means the product of the equity shares traded on stock exchange, the price for which each equity share is divided by the total number. So you have to take the weighted average. So the number of shares traded multiplied by the price, you will get the volume, that total volume divided by the number of shares that is traded. That will give the weighted average price. Very interesting. So that price is one indicator. Okay, just keep this in mind. That's as one indicator. Okay, volume weighted average price, volume weighted average market price. Okay, so now I'm going to take you to the various. So what is meant by the open market? What is meant by the tender offer and all this stuff? So now let me take you to the regulation 5. This is regulation 5. So in this, I'll take you to regulation 6, where the buyback is from open market, either to stock exchange or the big building. The resolution of board of directors shall specify the maximum price. Okay. So what is open market? Open market is maximum price. Now I'm going to give you one interesting case study. Okay. So this is the annual report of Sun Pharma. So please look at the annual report of Sun Pharma, and then I'll take you to the other reports also. So this is your annual report of Sun Pharma. Please look at this. Let me take you to okay. So the buyback. Please look at this. So this is your page number 35. Correct. Now look at this. The board of directors at its meeting, okay, held on 17th March 2020, had approved the buyback of company's equity shares of 1 rupee face value from the open market through stock exchange mechanism. So open market either to stock exchange or book building. So this is stock exchange. As prescribed by the buyback of security regulation 2018, the old regulation is 1998, at a maximum price fixed by the board. The board of directors fixed it at 425. Okay. Now, if any shareholder is asking for a basis, you have to provide. You can't say no. Okay. And there is a window period, you have to keep it open. Okay. Then that means if your market price is above 425, you cannot buy. Market price is below 425, you can buy. That means you need to keep money. Okay. So that money is called buyback size. That is 1,700 crore money. Okay. 1,700 crore money is kept free only for buyback. Okay. The buyback period starts from March 26 and it ended on It's actually 6 months from the date of opening of buyback. That's the maximum period. These are all as per the regulations. These are all as per the regulation. But alas, no equity shares has been bought back under buyback. As the volume weighted average market price of equity shares of the company. Okay, now what is volume weighted average market price? You know. Okay, the VWAP, okay, of the company during the buyback period was higher than the maximum buyback price. So that is why I went to that. This maximum buyback price, you should have a basis. So you can go by some model. You can go by income approach, cost approach, okay, DCF approach, whatever. You want to go, you can go by cost approach, you can go by your intrinsic value of the share. Any model you can apply. And that is why best to get the valuation report. Okay, that is why best to get a valuation report. Now, we have just now understood Sun Pharma. So now, I'll take you to Tata Consultancy Services. Okay, let me take you to TCS annual report. So this annual report will give you an idea. This is actually open market as Sun Pharma. So now what I will do, I will take you to, this is tender offer. Okay, tender offer. Look at this. Completed, I think I have to go here. Look at this. The company had completed buyback of 5 crore shares. Face value 1 rupee. On a proportionate basis through the tender offer. Tender offer. Now look at this tender offer. Open market stock exchange, I gave example of Sun Pharma. And now tender offer, I am giving the example of TCS. Okay. So what is the price? The price is 3,000 rupees. And this is fixed price. I repeat, fixed price. So let me take you to the SEBI regulation. So here, I'll take you to the tender offer Q. This is Q, tender offer. Tender offer means an offer by a company. So that is why the basis. Now here also the basis is there. I'll come. How do you do the valuation? The company to buy back its own shares or other specified security. Now this specified securities is your ESOPs. Okay, through a letter of offer from the holders of the shares or other specified securities of the company. And tender offer is a fixed price. So means an offer okay, through a letter of offer, and this is a fixed price. So open market, you will have a maximum price. Tender offer, fixed price. So please be careful. Okay. And maybe if it is book building, you will have multiple prices, then range will be there. So then you have to go for, maybe you can select. So if you take an average, then those who have quoted above that, you will buy back. Those who maybe you have quoted above, will you buy at a lesser price? No. Those who are quoted lower, you will buy at a higher price. Naturally, because you are offering at a better. Those who are quoting at above that particular average price, you will not buy back from them. So these are all the models that is given for book building. So book building, tender offer, open market book building, open market stock exchange, tender offer, of course odd lot. Odd lot is very unique. Okay, so where you have to go by proportionate shares. So first you arrive at a price. So you arrive at a fixed price. Better to go for a fixed price. So tender offer and all, odd lots and all, you cannot go for open market. Better to go for a tender offer for odd lots also. Okay, good. So now that is 5, 6. So then I'll take you to the schedule, which is a very important schedule here. That is schedule number 1. This is schedule number 1. This is the content of the explanatory statement. You remember that we had the content of the explanatory statement for a private limited company and unlisted public limited company which is said basis are arriving at a buyback price. Now here, contents of the explanatory statement, item number 4, maximum price, and with the shares, specialized securities. Now this is our proposed be bought back and the basis for arriving. The basis for arriving at the buyback price. The basis for arriving at the buyback price. Okay. The basis for arriving at the buyback. The basis for arriving at the buyback price. So this is common, whether it is the company share capital and debentures rules 2014, SEBI buyback of securities regulations 2018. The basis of arriving at the buyback price is constant. So therefore, better, it is best practice. I will not use the word better. It is best practice to have a valuation report. Okay. And engage an independent valuer. Engage an independent valuer. So maybe an IBB, a registered valuer, and or a registered valuer under section 34AB of the Wealth Tax Act. Any one. Okay. So both, or you can even have a statutory auditor also. Okay, to do that. So that is with respect to this, and I want to bring your attention. Maybe I'll take you to Dalmia. I have Dalmia also here. Okay, so this is granules. I'll just share with you the granules part. This is granules. Buyback. Please look at this. The board of directors at its meeting held on 21 Jan 2020, the shareholders, by postal ballot results published, approved the buyback of 1 crore 25 lakh shares, face value 1 rupee, at a total fully paid up shares at price of 200. That is tender offer, fixed price, tender offer. Okay, so tender offer. Now TCS, you will be surprised, guys. They have so buyback completed the third successful buyback, 16,000 crore. They have paid 3,000 per share, 1 rupee share, 3,000 rupees through the tender offer route, extinguishing 5.3 crore shares. Okay, which is our 1.42% of the total equity. So 100% equity now is being 98.5%. Okay, so this is very interesting. Now come to this granules. I think we are here. Granules are 200 shares. So 1 rupee share is 200 rupees. So 200 times. That's 3,000 times. The total number of shares bought back is 71 lakh. Okay, at a price of 200. Total amount utilized in buyback was 142 crores, excluding transaction cost. So transaction cost includes your transaction expenses, okay, valuation, all this stuff and other compliances, distribution tax, that is also transaction. So you can say, no. The entire money, that is called buyback cost or buyback size. The buyback size should include your buyback cost, distribution taxes, and the distribution transaction expenses. All put together is your buyback size. It's a very interesting term for your information. So granules we did. Let me try Dalmia Bharat. This is Dalmia Bharat. Okay. Now, this is buyback. Let me check buyback. Look at this. So, buyback committee, buyback of equity share. As per the resolution passed by the board of directors on March, company has completed the buyback of 61 lakh equity shares of 2 each from the open market through stock exchange. Okay, at the volume weighted average price of VWAP. Okay, volume weighted average price of rupees, not volume. You have two things. One is a volume weighted average price. Okay. Okay, where is Sast? And this is Sast. So this is a Sast regulation. So here we look at So one is your volume weighted average price, ZB. Okay, another is volume weighted average price, volume weighted average market price. Now here, please look at this. Is it volume weighted average price or volume weighted average market price? This is volume weighted average price, not market price. So therefore, they have not gone to trade it. Okay. So please be careful whenever these terminologies are used. So even though you are in buyback, you don't have these terms defined in buyback regulation. You have to go to SAST of rupees 531.96. This has resulted in a total cash outflow of 408 crore inclusive of all transaction costs. Now, this is a maximum price for your information. Now, price which is quoted, if it is below this, okay, so then they will go for it. So this is your volume weighted average price. And what is the maximum price? Maximum price will be above 531.96. Now, I gave an example of Sun Pharma, where the volume weighted average market price was above the maximum price. So you cannot buy. Now, here it will be below. Okay. So this is your amount paid upon buyback. Okay. And tax on buyback, transaction cost on buyback. These are the three. Okay. And of course, equivalent of that is transferred to capital redemption reserve. And cash flows, payment on buyback of shares. Look at these three: tax and transaction cost. This is paid to shareholders. This is paid to government. These are the various expenses. Okay, good. So the board of directors in this meeting approved buyback of fully paid 2 rupees each open market route for a total amount not exceeding 500. This is 500. Okay. At a price not exceeding 700%. So maximum buyback price is 700. So and the price not exceeding. So that is why the price was between 500 and 700. Okay. So between 500 and 700. So it was very interesting calculation. So good. So guys, we have understood why buyback, treasury shares, listed company models, then unlisted shares, and how the unlisted shares will be valued, especially under Rule 17. And in whether it is unlisted and private limited companies or listed companies, the message that is driven in the Companies Act is the basis for arriving at the price. That is mandatory. Now, how do you arrive at the basis for arriving at the price? The best practice is engage a valuer and get a valuation report. Now, who's that valuer? He can be any registered valuer, IBBA registered valuer, or he can be a registered valuer under Income Tax Act under Section 34AB of the Wealth Tax Act, or we can even be a statutory auditor. But the statutory auditor will be a person acceptable under the company's the debentures, the share capital debenture rules, but not here. Okay, for a listed company, it is better to have an IBBA registered valuer or a Section 34AB Wealth Tax Act approved registered valuer. Good. So that is with respect to buyback. I must thank and appreciate the initiatives of Institute of Chartered Accountants, especially the committee's initiative. Continuously, they have been sharing the information through this medium, webinar medium, by inviting the best of the faculties across length and breadth of the country. So my appreciations to the entire team. And thank you very much, Kirti Singhal, for moderating and coordinating this program along with the Institute officials. Over to you.
Thank you so much, sir. That was indeed a very amazing session. I hope our participants has understood everything about the buyback. You explained very amazingly, sir. Thank you so much, sir. I request all the joinees to put up the questions, if any.
Request, please clarify whether RV can issue on the basis of DCF method Also, registered valuer can issue valuation as per latest audited balance sheet NAV basis. Both way, DCF or NAV, there is no restriction to RV to select basis for valuation. Yes, there is no restriction. So either you can use DCF method or NAV method. Both are correct. Can any one of the accepted valuation methods be applied for valuation of buyback shares? Yes. But with respect to private limited companies, I'll give you an example. If you are following a method like income approach, say DCF approach, or market approach, okay, any one, maybe you have a comparable, so you take a market. Then the statutory auditor have to give a report to the board that this particular price, okay, based on which you are going to do the buyback, is not as per the bank's audited, is not as per the company's audited balance sheet. So that he will make a observation. That is only with respect to private limited companies and unlisted public limited companies. Okay. So otherwise, you can do.
Okay, I don't think there are any more questions, sir. Thank you so much, sir. You have explained very amazingly the topic.
Thank you.
Thank you, sir. Someone once said, try not to become a man of success, but rather try to become a man of value. With this, I'd like to introduce you all to another dynamic personality, CA Vinod Balachandran, sir. He will be covering the topic Accounting Standards for Non-Corporate Entities. Sir is a fellow chartered accountant in practice from March 2013. He has completed FCA, SB Bilimoria and Company Mumbai, ACIS Chartered Secretary London, IFRS ACCA certification, and DISA ICAI. He has also pursued Management Development Program, Indian Institute of Management, Bangalore in 2003. Sir is ICAI faculty for ICAI Student Program, GMCS, Orientation, INT AS Committee, IFRS India, Indian Institute of Chartered Accountants of India. I request Vinod sir to impart some of his widespread knowledge. Thank you. Over to you, sir.
Good evening. Today's session is on non-corporate accounting policy. There has been a lot of confusion in the past because for non-corporates, there was no particular standard or formats prescribed. Bulk of India is working on non-corporate entity, meaning proprietorship, partnership, trust, society, most of this unincorporated entity. So in bulk of these transactions, typical small T format balance sheet, profit and loss account, or some very basic information was being compiled. And based on region to region, the disclosures and the applicability of accounting standards was done based on necessity. In the year ending 2021, ICAI finally decided that there has to be a very methodology for non-corporate entities. So in 2021, it was decided that partnership, proprietors, societies, and trusts should follow certain account, which is in line with the government's MSME initiative. You would realize that during COVID times, because of financial stress, Government of India has revised the MSME limits, micro, small, and medium enterprises limits, up to 250 crore turnover. Taking a cue, ICAI also realized that for a small company where bulk of the companies have turnover less than 50 crore or maybe 20 crore, bulk of the companies in India, there is no point following so much of detailed financial statements and accounting policies. So ICAI realized that it is important to fit accounting standards into the framework of MSME. Now, when you go abroad in the IFRS environment, there are very clearly two classes of accounting, IFRS and IFRS for SME. That is, if you are a small setup, you need to follow disclosures and formats. It was very easy. In India, we have currently Ind AS, which is for companies exceeding 250 crore net worth, listed companies and large corporations. So we keep that out. Then we have the accounting standards, which was followed basically by all the private limited companies. There was a gap of as regards LLP because LLP was the concept was not clear. What kind of accounting standards should LLP follow? Because the government has not created any accounting standards for LLP. It's currently in process. Then we have all the partnership, proprietorship, societies, and trusts. So the private limited companies were following our erstwhile accounting standards. The LLPs was a big gap, which now the ICAI has plugged. The ICAI has said that till the time government implements or approves the accounting standard for LLP, LLP also will be treated as a non-corporate. That is, it will follow the accounting standards, not the MCA. So we have now partnership, proprietor, LLP, society, and trust. All these 5 entities now follow the new guidelines. These guidelines are not necessarily new. This was effective for the period 2021. It was issued towards the fag end of 21 with the result that many people did not 21. Now finalization is in process. Hence, it is important for us to understand what is the accounting standards to be followed for the non-companies. ICAI has made it very simple and easy to understand. So I will use a simple presentation to quickly run through a few slides. The government prescribed MSME, that is, they have micro, small, and medium, only 3 entities. While we are having actually, we call it micro, small, medium, and large. The limits prescribed by the ICAI is not exactly tallying with the limits prescribed by the government for micro, small, and medium. We are following a slightly different limits. So on the right side, you will see heading is non-company, meaning partnership, proprietor, society, and trust in 2021. For 22, ICAI has now clarified that even LLP also should follow the same structure. So if you are any of these 5 entities, the first thing we need to do is find out under what category we fall under. Are we a micro, small, medium? Based on that, accounting standards are applicable or not applicable, and based on that, we should make the accounts. So let us see what is this level 1, 2, 3, and 4. Level 1 is easy to understand. These are for large MSMEs, meaning turnover in excess of 250 crores. It's easy to understand. Borrowings in excess of 50 crores, all listed. Listed anywhere moves into Ind AS, banks, financial institutions, insurance companies. As you're aware, banks and insurance have not yet migrated to Ind AS. So they are currently using a mix and match, bit of accounting standard, bit of their own regulators' accounting policy, then RBI's regulation. So technically, banks and insurance company balance sheet are quite difficult to understand because it's a mix and match. Moment they move into Ind AS, there will be more clarity in their accounting, and all the accounting will move to fair value accounting. This chart for non-company, easy way to understand is turnover criteria. If your turnover is less than 10 crores, you are a micro enterprise. Largely, most small institutions, society, trust, all fall under this. Now, the definitions of MSME says it's only applicable for commercial and industrial, that is, if there is business. So technically, charitable organizations again are in a no man's land. They don't have any particular standard or format because they are not business. However, it is advisable that even the charitable organizations also follow the non-company accounting standards. Because then there will be clarity in presentation and valuation and understanding. Understood by all that non-business entities are not covered under this. 12A, charitable, religious, all those entities are following actually no particular format or standard. But please encourage them to use this. So there will be a base and a disclosure. So less than 10 crore means micro. 10 to 50 crore means small. 50 to 250 crore is medium. This is where the government's MSME limit also stops. 50 crores. 250 crore is large company. Accounting standards are applicable. You have no exemption. You have to do everything possible because you are a very large company. You don't follow Ind AS, so you will follow accounting standards. For Ind AS, the limits are 250 crores net worth, not turnover. So Ind AS is a totally different ballgame and all listed entities. So in India, if you travel, a bulk of the business are falling under level 4 and level 3, that is up to 50 crore turnover. So the ICAI has now given a lot of relaxations, doing business easier by giving certain relaxation in the accounting policies. So let us find out what are the relaxations, etc., for the various levels. So to keep in mind, level 1, 250 crore plus, no relaxation. You are a large setup, so you need to follow every possible accounting standard available. Our discussion will focus on level 2, 3, and 4, micro, small, and medium, or medium, small, in that order. So that is where the bulk of our business is, and that is where we need to know what we are supposed to do. Primary thing to do, whenever you sign any report of operator, LLP, society, or trust, make sure that a notes to accounts is attached to it. In most cases, we find that only an Excel sheet is there in most of the smaller organizations. There are really no notes. So you need to start writing notes. And in the beginning of the note, please make sure to write this, saying that as per the accounting standards prescribed for non-corporates or non-company, this non-company falls under maybe level 2 because the turnover is less than and more than 10 crore. Since it is falling under level 2, level 3, 50 to 250 is level 2. Since this business is falling under level 2, following are the accounting standards applicable and not applicable. So this has to be written in the notes. One is, what is the level this business is in? 2, what are the accounting standards you are following or not following, or what is applicable to that level? Extremely important to write these two in the notes. So the reader of the accounts will know immediately that this is an MSME. It is a level 3. Hence, the accounts will not contain certain kind of information. So writing notes is to be made mandatory. Do not file only an Excel sheet of the account, balance sheet, P&L, and note and schedules or notes. Please make sure notes to accounts are first will be disclosure, then policies. Now, the turnover or the borrowings could change every year, due to which you are maybe level 2 company. Next year, when you audit, you are a level 4. The year after that, you might be level 3 again. There's a question which comes that what happens to previous year comparative figures? So the ICAI has clearly clarified that if level falls from 1 to 2 or downward, from high to low, for 2 years, change the accounting policy. Meaning, if you are level 1, meaning you are more than 250 crore, you are a large company. Now, because of COVID, etc., your company collapsed, you only have 5 crore turnover. From 300 crore, you came down to 5 crore. So what the ICAI says is that for 2 years, you have to still continue using level 1 accounting. You cannot just keep on shifting every year between accounting policies of 1, 2, 3, and 4. So this is the primary learning. When levels changes, watch out for previous year. But this, we are not used to it. Now, 8 accounting standards, all levels. We need to learn by heart. Whichever business we are doing audit, these 8 accounting policies are mandatory, and you have to write in the notes accounting policy of this accounting policy and what are the issues. 100% compulsory. Disclosure, which we already discussed. Valuation of inventory, if you are having stock, inventory valuation. Cost is lower, before, LIFO, whatever. Weighted average. Contingencies as events occurring after the balance sheet date. That is, some fire happens on 31st of April, everything destroyed, or some other major bad debts happening. These are all examples of contingency events after balance sheet date you have to report. Net profit or loss is very basic. Prior period items, which you all know, there's nothing. Construction contracts, if you are into construction business. Revenue recognition standard. Accounting for government grants. Accounting for government grants, you know the methods. Government grant for the assets can be reduced from the asset, or you can show it as a deferred liability. And borrowing cost. Borrowing cost is very important because sometimes you might capitalize the borrowing cost for qualifying assets. So very, very, very important. So there are only 8 accounting standards which are mandatory now for non-companies. So this takes a huge burden off small. So always to remember that these 8 are always complied with, and it is mentioned in the notes also regarding these 8, whatever is applicable or not applicable, or there is a deviation or anything. In inventory, certain methods of valuation is not allowed. For example, LIFO, not allowed. Example. So we have to make sure we remember 8 accounting standards at all times whenever we are auditing small businesses. Now, what are the standards which you can just forget, that you don't care about it? Up to 250 crore turnover, you don't need to do cash flow statement. Very, very big job reduction. So literally proprietorships and partnerships need not disclose this. Segment reporting, totally accept. Earnings per share, it's irrelevant for partnership and proprietorship. Then all the consolidation standards. So nearly 7 standards you can just forget. as long as you're not doing an audit of a company whose turnover exceeds 250 crores or borrowings exceed certain standard. So in the previous slide, we realized that there are 8 accounting standards which we should always remember. In this slide, we are learning that there are nearly 7 accounting standards which we can always forget. It will not be applicable in our business. The rest of the accounting standards, ICAI has largely given disclosure exemptions. And certain standards, what is not applicable, we already saw, nearly forget. For the other standards, there are disclosure exemptions. And for one standard, there is a very, very good news, AS22 taxes. If your turnover is less than 10 crores, deferred tax entries. That is a very good news because these small companies, it was senseless to do a lot of deferred tax entries and all that because the proprietor wouldn't understand what it is, partners wouldn't understand, nobody understands. Only the auditor used to understand this, and the income tax anyway doesn't agree with this. So the good news is, if you are a micro company, less than 10 crore turnover, don't bother about deferred tax. It's a very, very big exemption. And the next biggest, related party transactions. See, that's very significant. For level 3 and 4, that is up to 50 crore turnover, you don't need to attach related party transaction list. So if you are less than 10 crore, you can forget deferred taxation. If you're less than 50 crore, you can forget related party disclosure. But be a bit careful there because I would suggest it's always advisable to put related party tax because it is very important as regards income tax department. Even though under the Income Tax Act, the definition of related party is very different from what is mentioned in the accounting standards. Income Tax Act is a bit more vast. When a litigation or some issue happens, and it is always safe for an auditor to show that he has anyway disclosed related parties. So even though the standard says you are exempt up to 50 crores, I feel that from a safety angle, disclosure perspective, tax disclosure perspective, even though in the taxation rules, the standard disclosures a bit more vast. So 2 very great exemptions, related party and deferred tax. And remember, most of the other exceptions are all mostly disclosures. You don't need to do very detailed filings and disclosures. So the chart given by the ICAI themselves for us to understand applicable. As I told you, no need to remember this by heart. 8 standards are always applicable. 7 standards are not applicable. And another 2 standards, you have got not applicability for certain levels. Disclosure deferred tax for level 4, no need. Related party for level 3 and 4, no need. So these are very, 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 very good exemptions given by ICAI. Slowly at this chart. These are just disclosure exceptions, not really very relevant because minor disclosures. Now, AS26, intangible asset. Remember that in the completed CA in the 90s, we did not have any intangible asset concept then. Intangible asset stopped at goodwill. We did not know more than that. With the IFRS and Ind AS environment kicking in, intangible asset is now a very major source of discussion and debate. Most of our balance sheet, you will see, are now shifting. The percentage of intangible is increasing and increasing. Intangible could be software, which is most common, royalty, copyright, patent. It's very, very important. Very, very important to capture intangibles and bring it in. Now, AS26, intangible, has been now aligned largely with the Ind AS. So those of you who have not read AS26 in a long time, I would suggest you please go through it because substantial improvement has happened in this standard. It's been brought in line with world standards. So you might, in your accounting, need to recognize certain intangible which was never done before. If you look at it, for level 2, 3, and 4, it is there. There is no exemptions. For level 4, it's a bit less. So AS26 is a very, very important standard wherein you need to bring intangibles into the balance sheet. Now, software is the most easiest way because almost everybody incurs some amount for software. Patent, copyrights, etc. for micro companies might not be there. But today, if you remember, most companies have now taken patent or they apply for patent license, etc. There will always be cost. Many times in the account, it is just expense of, don't do that, take it into the balance sheet and amortize. So there will be depreciation and there will be amortization. So very, very important standard is AS26. Then if you see AS28, it is impairment of assets. Now for smaller companies, largely nobody has bothered with impairment because we are doing cost-based accounting. In Ind AS, we do fair value accounting. So impairment is more severe. Here in cost-based, we are always of the opinion that what we account is always be more less than market. So there will be no need to impair. But that is a wrong notion, especially with COVID and its impact. There are chances that the value of your PPE or your assets are inflated or value of your intangibles are inflated, not in line with post-COVID scenario. So you will need to do impairment testing. If you notice, AS28 is not being removed. For level 4 companies, that is less than 10 crore, you don't need to do any intangible accounting. So that's a great news. So for small 10 crore less companies, no intangible, no deferred tax, no related party. So 3 things, keep it in mind. Less than 10 crore, you don't need to care about this. Now for less than 50 crores, they also have related party exemption, no need to disclose. Rest are all exemptions, disclosure exceptions. AS20 is also disclosure exceptions, except one big change. For smaller entities, this impairment testing is a complicated formula where you have to work out value in use. That is, if your asset in your balance sheet is 100 rupees and you do a discounted cash flow and something, and you say that as per the future projected earnings terminal value method, the asset is only enterprise value is only some, or the cost of that particular asset is only some 90 rupees. So 10 rupees is impairment. So what this ICAI has given the exemption is that if you're a company, smaller companies, small and micro and small companies, the advantage, this for smaller companies, the advantage is that they can do a reasonable estimate of impairment. They don't need to do very complicated impairment testing. That is why it says, with certain disclosure exemptions, than for micro entities, there is no impairment. For small and medium, you can do you don't need to do very complicated discounted cash flow, etc. You can do Value in use you can do based on some random estimate. So this is a very, very big leeway given by ICAI for small organizations, less than 250 crores, where you can easily correct your balance sheet to market reality by doing approximate, reasonable approximations. You don't need to spend too much money to do very complicated valuation, etc., which nobody will understand, nor give money for payment. So AS 26, which is intangible, and AS 28, which is impairment, are very, very important standards. Those who passed CA in the past, please review this, because these standards have been realigned with largely with Ind AS and are very world-class standards now. A lot of changes have happened in these standards. So we should not be caught off guard, thinking that what we learned many years ago, there's nothing in this. There is. Only thing is that the method of doing impairment, now ICAI has made it relaxed for small companies, saying that, for MSME, saying that you can do realistic approximate, no need to do complicated discounted cash flow, etc. Another very, very important concession given is for valuation of provision for gratuity and leave encashment. You will observe that many small companies do not make provision because they don't want to afford making provision. Nobody wants to show liability. They will tell you that no employees will work more than 5 years. So AS 15 is a very important standard, and maximum violations across India are found in AS 15 because they don't provide for gratuity or leave encashment. Like in today's age, nobody wants to stay in a company for more than 5 years to be eligible for gratuity. That doesn't mean you should not provide, you have to provide. So to solve this jinx of employees not interested in this, but as an accounting standard, we have to qualify the accounts each time, saying AS 15 is not followed. Profits are overstated. ICAI has given a very, very good leeway. One is all level 4 companies, that is less than 10 crore. And for level 2 and 3 companies, which is less than 250 crore, and having less than 50 employees, they don't need to do actuarial valuation. They can just make an Excel sheet provision and provide, just like impairment. So it's a very great leeway. If you have less than 50 employees, you can just make a provision entry for gratuity, leave encashment, and close the subject. Now, if you have more than 50 employees and you are a level 2 or 3, you have to make an actuarial valuation. But again, it has given, you don't need to do too much discounting, etc. You can do a basic actuarial valuation. So it's a very good leeway for up to 250 crore and less than 50 employees. Excellent opportunity to avoid costs and comply with the accounts. Please make sure you insist with your clients that they make a provision entry at least for gratuity and leave encashment. Even if they claim that employee will not stay for more than 5 years, it's mandatory under law to recognize employee benefits. Otherwise, your profits are not correct. It's overstated. So if you say when a person leaves, I will make payment, on that year, the P&L is going to be hit hard. So it's a very, very great option given by ICAI. So I would suggest that all of you make use of it. And any accounts which is audited and provided even for non-company has a provision for gratuity and leave encashment. At least a simple Excel entry is enough. That provision is given. No need to do very complex actuarial valuation if less than 50 employees. Then leasing standard. As you know, in the Ind AS, the leasing standard is substantially changed. Operating leases are capitalized as right of use assets in the Ind AS. The accounting standard, it is still our old world charm. The advantage is that now if you are a MSME, that is if you are a micro, small or medium, less than 250 crore turnover, a lot of disclosure exemptions have been given. Accounting has to be correct. Notes to accounts can be watered down. So those of you who are having leases, please make sure you go through. It is always good if you disclose everything. I am in favor of that. But those of you lazy enough to disclose too many things, you have exceptions. Certain minor exceptions are given that, certain 5-year, 6-year data or projected certain information or risk free or risk rate or something, those kind of notes, etc. You don't need to give. Another good part is for the non-companies, ICAI has also prescribed how you should put instead of share capital, it is suggested that you use the word owner's fund. This is what ICAI has suggested. Now, if it's a society or a trust, you can even, instead of owner, you can put society's fund or a trust fund. You can change it. Don't use the word share capital. That's a very good, improvement given by ICAI. There's a standard. The balance sheet P&L format are exactly like the Companies Act. Largely 99% like the Companies Act. So it's easier, comparable. Please do not give those T accounts anymore. Left side asset, right side liability or reverse or, P&L in T column. That is no longer mandated. Try to follow the Division 1 Schedule 3 format of MCA as much as possible, because even for non-company, ICAI has largely requested to adopt the Division 1 Schedule 3 Division 1 standard. Schedule 3 Division 1 of the Companies Act prescribes the balance sheet format for companies following accounting standards. Division 2 for companies in Ind AS and Division 3 for NBFCs. Then there will be Division 4 for banks coming up and Division 5 for insurance companies and so on and so forth. So many things will come. So for non-company, that is partnership, proprietor, society, trust, LLP, follow this. Now, the good news is that last month ICAI has, for this month, actually in the beginning, in July, they have given for LLPs a format for the first time. So LLP format is slightly different from this. The only difference is that partner's salary is now shown on the face of the P&L in an LLP format. But if you are a partnership, the ICAI does not prescribe showing partner's salary in the face of the P&L. You show it as employee cost or whatever, salary cost. There's a minor change. So for LLP, now slightly different format has been prescribed by ICAI. So those who are auditing LLP, etc., please follow the new format. This is not the LLP format. Profit and loss account, there is a minor change compared to the Companies Act. In the Companies Act, if you would see, the first two lines were purchase of stock in trade or finished goods and change in value of stock. That was the first two lines. Now for non-company, ICAI has merged those lines into one simple cost of goods sold. So do not blindly copy phrase from Companies Act. A minor change has happened. Purchase of goods and consumption and change in inventory all comes under one line called cost of goods sold. The last line you can see. This is a minor change. Now, what is cost of goods sold? Please attach a schedule and it will give all this. So cost of material consumed, purchases, change in inventory, all will come under one schedule of cost of goods sold for non-companies. Now, even though it's not connecting to us, we should also know that for the year 21-22, if you are a private limited company, there also minor exceptions have been given by ICAI. This is through the Companies Act. So up to now, what we were looking at was Partnership, Proprietor, Society, Trust, LLP. They will follow non-company accounting standard level 1, 2, 3, 4. Based on that, divide the accounting standards. Now, if you're auditing private limited company from 21-22, this is your last year's audit. So minor changes have been made. Just take 2 seconds. In line with government diktat, up to 250 crore is now treated as a small and medium company, out of which small is now 20 crore limit turnover. Previously, it was 2 crore. The advantage of small is that you don't need to attach cash flow statement. So please remember that as regards those who are finalizing private limited companies under the small and medium company category. Because many cash flow statement previously was applicable only up to certain levels. The rest of the formats are same for private limited and the non-company. Now we have now covered the very basic of ICAI's accounting standard applicable for non-companies. To make it easy to understand, non-company means partnership, proprietor, LLP, society, trust, those in business. Charitable, etc. are not covered by this, but it is advisable they follow this standard. Largely, the balance sheet P&L has been merged in terms with the Companies Act. Do not give the T accounts like before. Please make sure notes to accounts is always written with the Excel sheet. The notes to accounts should contain, the first paragraph should be, what level is this non-company? Is it level 1, 2, 3, or 4? And for these levels, what are the accounting standards followed or not followed? These are very basic concepts. Top of the mind recall. If you're less than 10 crore turnover, no deferred tax, no related party transaction, no impairment, no cash flow statement. A very, very good. No need actuarial valuation of employee benefits. So for less than 10 crore, a bonanza of no need to remember and do many things. Another very big change is for level 2 and 3, if your number of employees is less than 50, you can still do some accrual figure for provision for leave encashment gratuity. Otherwise, do actuarial valuation. Then the big thing, impairment. Again, level 4 is exempt. For others, you can do simple, you can do your own some maths for the impairment. You don't need to do complicated discounted cash flow, etc. Like what's in the Indias or for large companies. Now remember, non-companies, this rule is effective from 2021, previous year. So this is the very basic. If you have any questions, etc., I can take it up. Thank you very much to UKG and ICAI for this opportunity. Madam, if people have any questions, I can take it up, or you can share the PPT to them.
Okay, sure. Thank you so much, sir. That was indeed a very amazing session. I request all the joinees to put up the questions, if any.
I think there are no questions.
We have one question.
Sure. Can you read out? I can't see.
If income tax raises any question over valuation by statutory auditors in case of private limited company, please clarify on this.
Yeah, normally Income Tax Act has a concept called, merchant bankers. That under income tax, normally they only allow merchant bankers to do the valuation. The Income Tax Act is not yet updated to the IBBI registered valuer concept. But I have a feeling that as long as it is done by a registered valuer, there cannot be much of an issue. Even though Income Tax Act says merchant banker. Now, so I think the act is still old and they have not yet updated it. I slowly will come, but preferably I would suggest everybody gets it done through registered valuer so that there is no issue at all. The registered valuer licensed to give valuation, not necessarily a banker, merchant banker, or who are licensed valuers can do. So that is my suggestion. But Income Tax Act allows. So they can actually, if they want, they can raise. But as I understand, they don't raise it anymore now. Because now IBBI valuation is strong. So as long as somebody from IBBI values it, I think our registered valuer values, I doubt whether they can raise any issues.
Okay. There are no more questions, sir.
Okay, thank you.
Okay, thank you so much.
Thank you very much.
I'd like to give my vote of thanks to the CPE committee for giving me this opportunity. Thank you, CPE team.
Thank you very much. Thank you.
Thank you. So this is CA Kirti Singhal signing off for today. Hope you all enjoyed the session and wish you a great day ahead. Thank you.
Thank you. Thank you.